Okay, we are here with a very special guest, Dr. James Thorne, the Chief Market Strategist for Wellington Altus Private Wealth. For those that know me or don't, my name is Dimitri Korolis. I'm an advisor within Wellington for Cresco Wealth Management. Dr. Thorne is someone that is a huge resource for all Wellington teams across the board. You may have seen him on BNN, Market Insights, and newsletters, and his publications in Globe and Mail, just to name a few. And what we've decided to do, and Jim, thank you for your time here, is we've decided really to do a video series once a month, and something that's just, you call it a market quick hit, just an overview and an opportunity for clients and guests to really ask some questions, and get your insights, because I find them very invaluable. But Jim, welcome to the Wealth Cast, if you will.
Thanks for having me, Dimitri.
Yeah. No, it's my pleasure. So this is good. I want to keep it a little bit fun. I want to keep it exciting. And I guess what we'll start here is things that clients are talking to us about, and where your head at and where your insights are. And one of them is the big one: impacts of the war. There's a conflict in Ukraine and Russia. There's a conflict in Israel, Palestine, and the Gaza area. And what impacts are we looking to have on that?
Oil's at what? 75 bucks. Wholesale gasoline is broken 220 and is at 215. So the concern about going into the conflict was that we were going to get a spike in oil prices, in gasoline prices. Typically, it goes the other way, right? Typically, you want to buy when the cannons start firing, right? So, market's gone up. The situation in the Middle East has existed since the fall of the Ottoman Empire after World War I. Is it a crisis? Yes. Is it a shame? Yes. Do we need to solve it? Yes. But will it stop digitization? Will it stop the march forward of the global economy? No. Is this any different than the Lebanese war in 2006? No. So does it change the geopolitical players on the board? Yes, of course. Will it have long-term ramifications? Yes, it will. But in terms of building a portfolio, and what my thesis is, nothing's really changed.
Okay, no, that's excellent. And what about those that'll talk about and say, okay, I hear what you're saying, top down, that sounds great, but come the winter time, are we going to run, when we get into that January, February, March, are we going to run into another $100 plus barrel?
No, I've been saying this all along. You sell when it's over 90 and you buy when it gets below 70, right? And I said, it looks like they're going to take oil. What's going to provide a bottom is, the U.S. government has to fill the strategic petroleum reserve. So they're going to start doing that. The global economy is starting to slow. Energy in the United States, they're manufacturing the most ever. The United States and Canada are fossil fuel superpowers. So my view had always been that the objective is, for those in the energy patch, is to find that stable price, whatever that is. And in my mind, I pick 85, but it's somewhere between 70 and 90. Everybody makes a lot of money. Look, I know the stocks are going to go down, but big oil producers have already hedged out their production, right? So that the stocks shouldn't be moving, right? But they do, and that's just the way the world is. So in my mind, it's $80 oil, $85 oil. Everybody makes a ton of money at that price. Energy stocks are now technology stocks. I don't know if you come across it in Calgary, but I've seen lists where ExxonMobil is in the top 15 technology companies of the world, and it's a big theme where, Dimitri, every company is going to have to become a technology company and digitize. And if they don't, they're going to get wiped out. So the sooner we flush or put into the waste paper basket the biases of the 1990 that says technology is risky, the better. So I'm very constructive on it. But let me rephrase that a little bit, right? It's not the only game in town. So when you're building a portfolio, do you want to have energy? Of course you do. My reference point for a balanced portfolio of value and growth is the S&P 500. In the S&P, there's 5% energy, right? I think you should have somewhere between 5 to 7. I don't think you should have 20% or 25%. And so I like it. I think you buy high quality names. I think they've delevered their balance sheets. I think they're well managed. I think they're embracing technology. They're core holdings in any portfolio, but there's going to be volatility. So listen, when oil gets above 90, right? I mean, I put out this piece internally, and I got a lot of pushback. When we got to 95, we got what was called extreme backwardation. That's very bearish when you talk to the guys on the floor of the CME. Everybody freaked out, right? Where is it? I just sit there and go, you know what? I'm not going to argue anymore, right? Where's oil? $75. Where are all those people that said, backwardation is bullish? No, extreme backwardation is not bullish. So my point is, have enough in it. It's going to be good. There's going to be good managements. They've delevered the balance sheet. They're going to pay a good dividend. Although what is very interesting moving forward is notice that mergers and acquisitions have started to happen in the energy patch, where the folks are now going to the TSX or the New York Stock Exchange to buy reserves and not basically do. So it's a new phase, right? It's a new phase. This cycle, I would suggest you will end like every other cycle, where teams will eventually start to spend do CapEx that is greater than their free cash flow. I don't buy that this time is different. Just might be a little bit elongated, but I don't buy into that the world is going to wean itself off of fossil fuels in my life. In my lifetime.
Yeah, absolutely. Those are great points. And thank you, Jim. I really appreciate it. I want to go back, and I mentioned it at the top, is that internally we get the market insights that you write every month. And we get those. And I know that sometimes you're putting them on social media, on your LinkedIn page, on your Twitter as well. And we'll, in the link in the bios, we'll have that information for the listeners. But you talk about, it was about a 90s rewind and entering in a deflationary time period. And if we were to talk about 2024 and your thesis, just piggybacking off this article, can we touch on that for a few minutes here?
Sure. So this month I used Steely Dan, and the song is Eddie Major Duke, and it's the B-side of Ricky Don't Lose That Number, and it's now become a cult classic. And what the song talks about is everything's going to be okay. Right? Everything's going to be okay. And so I wrote it because, typically, Dimitri, every year we go through a weak period in September and October, and we tend to forget, right? Between quad witching, which is the third week of September, Rosh Hashanah, Yom Kippur, and then we have tax loss selling for mutual funds and hedge funds into October. So for a lot of folks, year end for a lot of managers in the United States is October 31st, not December 30th. So every year I get calls, oh, it's the end of the world, right? It's the end of the world. So let's go back and think about this, right? It comes down to this. We are still in the debt mess. Okay. The debt mess that we're dealing with before COVID is even worse today. Okay. We're going to go back to low growth and low inflation. Okay. And the argument had always been moving forward. I'm going to get a little bit more explicit in the next month, but the argument had always been going forward, is that as after World War II, we're going to be able to use a Marshall Plan, a big infrastructure plan, to support economic growth. Well, because of what happened with Mr. Trudeau and Mr. Biden in terms of their basically fiscal policy run wild and the extreme level of debt that we have right now, that will not be the case for at least a couple of years, right? So what that leads me to believe that we're going to go into a slow growth environment. So you're going to want to invest in secular growth names, right? You're going to want to invest in digitization. You're going to want to invest in the Magnificent Seven. You're going to want to invest in Microsoft. I also talk about you're going to want to have to think about crypto, right? Because it's going to be embraced by Wall Street. And so what I want to do and what I'm going to amplify as we move through is the biases that people get because they listen to the media, right? The bias today is that technology is riskier than an old economy analog stock. Okay. In other words, Singer sewing machine, right, is safer than Microsoft, right? And you deal with that more than I do because you talk to your clients, right?
That's right.
So when you go back and you've seen what I've gone back in time and I've said, look, if you want to achieve your financial goals, right? This is my job. This is like us going back to university. Okay. Dimitri, you and I are taking a course. Okay. You and me. Yep. And I go, Dimitri, I've gone through, I know this prof, I've gone through his courses. You know what? If we study these 4 midterms, these 4 questions, and it's 100% final, I will guarantee you all 4 of these questions will be on it and we'll get 100%. Okay? This is true story, right? Don't.
By the way, it sounds like you went to school with me where I'd be asking you what's on
right.
the test.
And so I would sit there and go, Dimitri, on this course, in public finance, memorize these 4 questions. You don't have to go to class and you don't have to read the book. Right. I've got to go over here into calculus where I've got to work every day, 9 to 5 on cal or accounting or finance or modeling. Okay. And the point is that some people will agree and basically take the 4 questions and go and do it. And other people will read the book and go to the courses and do all the work. Right. So my point as a strategist is to say to you, look, the NASDAQ 100 has outperformed the TSX by about 14% PA since 2009. Okay? That's fact. All right? You want to achieve financial goals for your client. Okay? If you want to marry yourself to the TSX, realize you're basically investing in the 4th best index that you could, and you're going to make your job harder. Dimitri, you can go and do all this other stuff if you want to. Make it harder, right? I'm not saying that Canada is not a wonderful country. I moved back home. But if you sit there and just look at the data and check your biases at the door, right? And realize that the average Canadian has 50% of their portfolio, 52 to be exact, according to Vanguard. In Canada, when it should have a max of 3. And the TSX this year is up 1%. And the NASDAQ 100 is up 40%. You guys can pick whatever you want to do. What I'm trying to say to you is, and you're going to sit there and go, well, it's risky. I'm sorry. Microsoft is not a risky company. Apple is not a risky company. It's the largest holding of Warren Buffett and Berkshire Hathaway. So in all of this, what I'm trying to get people to understand is this is behavioral. Your biases that you develop listening to the media are hurting you achieve your financial goals. Right? Look,
plain and simple. Absolutely.
Say plain and simple. Look at it. If you want the best one, and this is just data, right? Bitcoin and digitization of currencies and blockchain is outperforming the NASDAQ 100. And we've got Wall Street embracing it right now. So my whole point is you guys can do whatever you want. You want to invest in only Canada? Nobody's forcing you to. It's not like the 90s. Right? Nobody's forcing you to. If that's what you want to do, then all I'm going to say to you, it's going to be harder to achieve your financial goals.
Yeah.
Right.
Agreed.
And that's it. It's that simple. It's that simple.
I still want the answers to the test though.
Oh, you got, well,
Yeah,
the end.
no
Well,
matter
think
what.
about it. But Dimitri, think about the pushback. I sent it you would not
Yeah.
believe the pushback I get.
But you touched on it. It's home bias, Jim. It's complete home bias, and you know the average Canadian investor, as you say, 52%. We see, we feel, we touch, we look, and we put it in, and we just assume that we're the be all end all. And I always say, if we lived in Switzerland, would we be looking at Canada saying, well, we should put over half our money there for the sake of it? And I
Right.
like how you
Well,
broke it down, right? Between, look, it's one thing to live here. We're not saying it's a bad country, but we have to look at from a portfolio standpoint.
exactly. Look at you. Think about this. Your client should be thinking about this. I am an institutional money manager, and I'm not in Calgary. I'm in the city of London.
Yeah.
And the portfolio, their personal portfolio, you can allocate that anywhere you want in the world, anywhere. And just because you live in Calgary or Toronto or Vancouver doesn't mean you have to have a massive portion of your portfolio. Because what I would say to you is, look, it's not to say there aren't good companies in Canada. There are, right? I mean, and they're very, but if you and I are sitting here building a portfolio and we can choose companies from around the world, right? I would basically, and here's the thing about the NASDAQ 100, right? It's got Costco in it. It's got Starbucks in it, right? You know, the S&P 500, right? It's almost 2/3 are small and mid-cap companies that have yet to evolve into the digital economy, right? You know, or I talk to somebody and say, oh, I want to buy, I feel comfort in buying something in the old economy. Well, Dimitri, in the 60s, there was this thing in the United States called the Nifty 50. Okay. And in the Nifty, and everybody, you had to own the Nifty 50. Do you know what was in that company, in the Nifty 50? Polaroid. Polaroid ceased to exist. Why did Polaroid cease to exist? Because I can take a picture with my phone.
Yeah.
Singer sewing machine. So your clients have to understand is what is comfortable looking backwards is hampering themselves looking forwards, right? And so we talk about it a little bit this month, but we're going to get really into it because here's the point.
Yeah.
Economic growth is going to dramatically slow when the sugar high of fiscal policy wears off, which means you need to invest in companies that have secular growth themes behind it that support the growth. So rates come down, inflation comes down, growth comes down. You're going to want the biggest theme in our generation right now is the digitization of the global economy. Just have enough exposure to it is what I'm trying to get people to understand.
Jim, thank you very much. I'm going to pivot really quick. I wanted to carve out some time with us for questions that clients had as I was talking to them in preparation that we were doing this. So you perfect segue because you really just touched on it. I had a questions. Dimitri, can you ask Jim? Realistic expectation: will rates fall, and when?
Canada is entering into a recession already. We have extreme levels of debt. I would expect, so when we wrote our forecast this time last year for this year, we thought pause in November, cut in December for Canada.
Yeah.
It's going to be between now and Valentine's Day that the Bank of Canada cuts, right? And then it will be between now and March that the Fed cuts. And I would expect, people need to understand and expect how rapid the rate cuts are going to be. And the real question is have they done enough damage, right? This higher for longer thing is just wrong. Yeah. Have they done enough damage? And so if you think about World War II and World War I, we've had a sugar high. We've had a sugar high because of fiscal policy. The growth is not real. Okay, the growth is not created by the private sector. I mean, maybe in Calgary it is. Okay, so let me just with the energy patch, right?
Yeah,
Fair.
fair point.
But in downtown Toronto, we got people filling potholes and sweeping streets. That's not real. It's going to end. And if you use a war, and you use World War I as the example, because you had World War I, then you had the Spanish flu, right? You had a dramatic decline in economic growth. And in 1920, they had the forgotten depression. So I think you're going to be surprised at how quickly and how dramatically growth slows, and how quickly and dramatically interest rates are get cut. And in that environment, Microsoft is going to do great. We don't know about, I think, you know, and then what would happen, I think, in your minds is that real estate should trade sideways for a decade. Okay. Then you sit there and go, I'm going back to the 90s and say, and fiscal policy will not be there to support economic growth because of the high levels of deficits, because Trudeau and Biden spent money when they shouldn't have in 21 and 22 and 23. They shouldn't have. Okay. And so now we got to come off of that sugar high, and you're going to have this deficit problem, and you're not going to have fiscal policy supporting economic growth. Then you're going to have the Fed and the Bank of Canada, let's say, cut 250 basis points. And then we're going to see what that looks like. Touch it, feel it, taste it. And what I'm trying to say to you is, coming out of the 80s, and this is sort of the narrative for crypto, right? Coming out of the 80s, what the banks did, remember, real estate went sideways in the 80s. Okay. And coming out of the 80 crisis, real estate went sideways in the 90s in Canada. But banks did okay in Canada, because I know everybody owns banks up here, right? But the reason why banks did okay was in the late 80s, early 90s, they bought asset managers. And what that asset managers did is it gave them another business line to generate economic growth through a period of time where they weren't making money in the real estate, and real estate healed. They need another product line. My friend, that's crypto. That's blockchain. That's the digitization of assets. And you have the largest financial institutions in the world saying, you know, it might be Bitcoin, and we're going to start coalescing around Bitcoin, but the digitization of assets, taking a private asset, digitizing it, and having it trade on an SEC approved exchange is going to generate a huge amount of economic growth and earnings growth for Wall Street and Bay Street. This is going to be out of a matter of necessity. They need to do this. And Dimitri, it's happening right now. So that's why when you read my pieces, and I'm going to go into a little bit more detail next, is I'm very constructive moving forward, as long as they cut. But hear me out. Please buy the NASDAQ 100, right? Please get innovation in your portfolio. Please avoid the old economy areas that are tied to economic growth. We're going back to a period with slow economic growth, with no help from fiscal policy. If you think it was bad before COVID, it's going to be worse. What did your portfolio look like before COVID? And talking to Calgary in the oil patch, you guys had 1 year, okay, where you guys were the only game in town. That's it. Now, do we go back to the winter of energy? Of course not. Of course not. But it becomes an important element of your portfolio, but it's not going to be the only element in your portfolio.
Is it fair to say, Jim, in hearing all this, is that, and not to put words in your mouth, but elaborate, that 2024 should be, let's put our gloves up, play a little defense, and really what we should be expecting when rates come down, all these things you're talking about, that it's really 2025, 2026 that we should start to see the momentum take place? Broad strokes.
Okay, so it's all predicated on the fact that, you know, because we hear this big conversation that the Fed put is gone, right? The Fed's no longer going to support the economy, right? If something happens. That remains to be seen, right? I mean, interest rates being taken down to zero, they didn't do that on their own accord. There was a gun put to their head, right? So what my view is that the Bank of Canada and the Fed are going to cut rates to support economic growth and stability, right? And they're going to take it down to 2.5% because that's the natural rate of unemployment. That's the natural rate of interest rate that they think. Does it go right through to zero? that remains to be seen. But what I would say to you, if that's what they do, then I'll just say this. I think 24 and 25 are going to be fine.
Okay.
I think what you're going to see is you should plan, going back to your previous question is, or a couple of questions, is interest rates are going to decline until 25.
Okay.
I think you should plan on interest rates coming down at least 2.5%, but they may go all the way to zero depending on how bad it gets. Don't know. That's not my base case. And in that environment, I still think that you're going to get a 10% year, because this is what you're going to get is a magnificent 7, or those big tech names, or the massive weights in the S&P 500. Right. So the S&P is going to be dragged. So I think the S&P is going to be 10, but I think the NASDAQ 100 is going to have a couple of good years. And I think what you need to get positioned for is the natural normal correction going into a midterm election cycle, which will be 26. And then from 26, folks, which just happened like last year, pardon me, is you're going to have a 15 to 20% correction. And then the market bottoms just before the midterm election, and we rally and we go. But I honestly say that people are going to, as we keep going on, people are going to realize that digitization and innovation in every company is going to have to be a technology company, irrespective of their sector. And if you identify who those companies are and you put them into their portfolio, you're going to have a wonderful run. So no, as long, so this is obviously it's a base case. So if we see, so what do we have? We have Canada entering into a recession. If we continue to see the deterioration of economic growth and the Bank of Canada does not start to cut rates, that will be a very big concern. Remember, 30% of inflation in this country is caused by mortgage interest costs. That is the Bank of Canada raising rates. Yeah. And remember, inflation is the year-over-year change, in prices. So if nothing happens, if everything just stays flat and the Bank of Canada does nothing, CPI will be 30% lower by the middle of next year. So then if they start cutting, it gets worse. And so what I'm trying to say to you is, Dimitri, by this time next year, we're going to be dealing with the CPI below 2%. And you're going to be dealing with, and the media is going to change their pivot. They're going to pivot like that, and their narrative is going to be like, and they're going to say the woulda, shoulda, coulda, and it was obvious to everybody. Yeah. Right? Yeah. Right? I mean, look what's happening now. I mean, we were the only ones, as an independent going on and basically saying that, the Bank of Canada was making a mistake, right? We were the only ones talking about all this. I would go on TV and just get attacked by the banks because the banks are pushing the status quo narrative. Well, guess what happens? Now they're taking our narrative, right? Right.
Mm-hmm. Mm-hmm. And I've
I can go.
I've watched you do it every time, and it's quite comical.
It's but investing is about the future. I mean, I'm talking to folks in Alberta, right? It's like Gretzky, right? Skate to where the puck is going, right? This time next year, you're going to have low growth and I would suggest inflation below 2% and a growth scare, which is exactly what happened after World War II and World War I. And like that, you're not going to be able to have government policy like Justin Trudeau and Chrystia Freeland will not be able to spend money like they have. COVID is over. I'm sorry. So if you've got this slow economic growth, right? If you got this slow economic growth and you don't have fiscal policy, we're going to come back to this world of pushing on a string, right? What we talked about 2 years ago, which everybody forgets, right? Monetary policy can only do so much, which will be, it will stop a crisis from happening, but it will not stimulate economic growth, right? And so it'll stop the real estate market from blowing up, but it won't allow real estate to be a growth sector. And then you sit there and go, what about energy, right? Well, energy, because of climate change and what have you, energy is going to be fine, right? But think about it. I mean, I'm talking to people in Calgary. Energy companies are being managed like consumer staple companies. right? They're not growth companies anymore. What are energy companies doing? They're taking their free cash flow and they're returning it to shareholders. They're deleveraging the balance sheet. That's not economic growth. So tell me, this is what I keep saying to you want to invest in Canada with what? Why? Where's the growth? And in the 90s, when we were at the forefront because of Bell and Nortel and JDS Uniphase and Newbridge Networks, I can go through, and Research in Motion. We invented the phone, the smartphone. We had economic growth because we were there. We were at the pole position of innovation.
Mm-hmm.
We got Shopify. That's it. We got nothing. The cupboard's bare. Productivity growth is negative. Well, I can keep going. Productivity growth in the United States is 5%, -2 in Canada. So I'm a Canadian, right? I love Canada, but I'm trying to attack this as an objective international investor. And Canadians need to do the same. Just as Canadians are global in the way they view the world and are informed about what's going on in the news around the world, the paradox is they invest provincially.
And you touched on the right point, Jim, is the fact that our job, yours and mine alike respectively, is that from a behavioral coaching and to really take yourself out and give an objective opinion. You can fill yourself with as many yes people as you want, but it doesn't serve any purpose. Okay, thank you for this. I told you I'd do something fun with you at the end. Okay,
right,
so get ready for this. There's a couple questions that are relevant and some that I just want to know.
Okay.
Okay, here we go. There's 5. So
Okay.
rapid fire. Okay. Quick hit. Hard or soft landing?
Hard landing in Canada, soft landing in the United States.
Okay. Is Jim Thorne bullish or bearish?
I'm bullish.
Love it. Best geographical sector to invest in next decade?
US.
Okay. Is Cresco Wealth Management your favorite team under the Wellington Altus umbrella?
It's my favorite team in the world.
And last but not least, are your Toronto Maple Leafs actually going to make a decent run at something this year?
No. and then that gives me that folks, that's me dealing with my psychological biases. See, if you talked to me 20 years ago, it would
That's
be
right.
We're building, we got the parade route, we're gonna do it. No, I mean, it'll be nice if it happens. It would be nice once in my lifetime, but we'll see. I don't think so.
Yeah. Well, I was going to say, so that's the test question, just to see if you were a true objective thinker, because everyone else in Canada and the world that follows hockey knows that the Toronto Maple Leafs probably won't amount to much. But
think about it.
I'm in Calgary, so I can't.
But Dimitri, think about this. When Calgary won the cup, it had a fantastic team, a dynamite team, and it had a lot of good breaks going through the playoffs, right? I mean, who would have thought that the old man Lanny McDonald would have scored the clinching goal against the Montreal Canadiens? I mean, but that team, think about that team, how good that team was, and think about how much pain the Flames fans had to deal with the Battle of Alberta, right? With the Oilers, right?
Yeah.
So, are they good enough? Sure, but a lot of things have to fall in place, but they have yet to prove to me. The Leaf organization has yet to prove to me that they understand how to build a championship team.
Yeah. Yeah. No, fair enough. You know what? We'll think of something crafty. We'll do, maybe in the next episode or so, we'll do a little mini bet or something, put some skin in the game, whether it's a dividend or whatnot.
What I'm more of an NFL football guy than
okay. Well, you know what? I can't give the listeners all of our all the goods in the first episode, Jim. We'll do a stop here for today. I really want to thank you for your time. Again, I can't reiterate, you can listen to this video. We are going to put it on our podcast channel as well on Spotify, which is the Cresco Wealthcast. You can follow me at the Finance Greek on Instagram, as well as Cresco Wealth Management. Dr. Jim Thorne, Wellington Altus Private Wealth, the Chief Market Strategist, the Twitter handle, as well as contact info to get the market insights and all the information you provide on a timely basis every month. We'll allow that for the listeners as well. But this has been fun. I really thank you for your time today.
Be safe. Take care.
Yeah. Take care.